Could all of this keep the Fed on hold for longer? And what does it mean for investors? Joining me now is Stephen Parker, co-head of global investment strategy at JPMorgan Private Bank. And Tom Porcelli is the chief U.S. economist at PGIM Fixed Income. Welcome to both of you. Tom, let's just start with the data. Yeah. So we had better than expected jobs report Friday. We have the better than expected ISM services. The manufacturing wasn't horrible. What does it tell you?
Yeah, look, we're in a sort of this squishy, tricky spot right now, and we expect that will remain the case. I mean, until we get some clarity on what's going to happen from a tariff perspective, we think that this push-pull dynamic, which I think is playing out really nicely in the data, we think that will persist.
Can I ask it this way? Are you bullish or bearish on the economy right now? Do you have recession in your forecast?
We don't. So we expect the economy to continue to expand. We expect it will expand at a slower pace, certainly than what we saw last year. I mean, that was always baked in. I think the question now is, the degree to which the uncertainty remains in place and what kind of downward pressure does that continue to put on economic activity.
But it's so unusual to have consumer sentiment this bad, to have the leading indicators as bad as they've been. I guess we just throw that all out and just say, look, it's an unusual period. The Fed pulled off the soft landing, as Michael Dardo was writing about over the weekend, and now we just have to question the size of the hit from here.
So this is an important idea, and I think the thing that we should just keep in mind is that I think people are very sort of willing to dismiss the soft data, right, the sentiment data. I think it's hard to do that, and I get it. Over the last few years, there's been this divergence between the soft data and the hard data, right? Like what people saying and doing have been sort of different. But I think when you have a setup where wages are on the slowing down, when the labor backdrop at large is slowing down, I think that's the time when you do want to pay attention to what's happening from a sentiment perspective. And if you look at something like, a sentiment for people making $125,000 or more, even that's starting to slip, right? So when you have this sort of this confluence of factors that are sort of, separate from what the headline is telling you on the sentiment level, I think you do have to pay attention to what sentiment is suggesting.
If you have two cuts in your forecast, kind of back half of the year, quarter-point cuts, do you think the Fed is basically pretty hawkish on Wednesday? Or
yeah, I think the Fed is very incentivized to say exactly what they've been saying, which is to say, look, we want to see how this unfolds. We're sort of on the sidelines for now. We think when cuts do come, and we do expect cuts this year, we just expect they'll be backloaded.
All right. So, Stephen, against that backdrop, and you can feel free to differ with that however you might, what does that mean for investors? I mean, the market has come roaring back, pretty much all the way back. So what now?
Yeah, Kelly, we're in agreement. We actually think that you're going to see two Fed cuts in the back half of the year. And we agree that the longer this uncertainty persists, the greater the risk that the hard data, what consumers are actually doing, starts matching up with some of the concerns. But we think markets will make new highs by the middle of next year. And we think that the rally that you've seen in the equity markets over the last month or so gives clients an opportunity to take a little bit of a health check in their portfolios to make sure that they're appropriately diversified, because we think this uncertainty is here to stay. We're telling clients to get comfortable being uncomfortable.
Sure. Well, that's hard to do. Do you see new highs the middle of this year or the middle of 26?
We think by the middle of 26 we'll see new highs, and depending on the direction of policy.
How about the middle of this year?
Well, after what we've seen over the last couple of weeks, certainly the direction of travel is higher. I think what we have to keep in mind is in a policy-driven world of uncertainty, the range of outcomes gets wider, but it also means that you have potential for upside surprise as well as downside surprise. And if the direction of travel around tariffs, which has been lower, continues, if we start getting some of the positive tailwinds on the policy front, so think tax cuts and deregulations, those new highs may get here a lot sooner than expected. We're also focusing on certain parts of the market that you want to be exposed to.